I wouldn't mind turning this conversation into, okay, as a Canadian, I'm sitting here. Obviously, I'm going through my replies and DMs, and people are now asking me, well, what does most Canadian initially think of? They go, oh, what does this mean for the housing market? Right. So I think to sort of unpack that a little bit further, they go, okay, this is obviously happening, you know, continents away from where we are. I don't really understand what it means. Yeah, something's going on in Ukraine, whatever. But like, now what? Like, okay, so we've got, oil running through over $100 a barrel, which is obviously highly inflationary. As we talked about, oil is basically life. It's the cost of energy. So if that goes up, everything basically costs more. How policymakers going to digest this, right? I mean, arguably higher oil prices, an outbreak of war that's obviously inflationary, coupled with the fact that we're already dealing with 30-year highs in inflation, but these central banks really want to be tightening into this, shit show. Let's call it what it is. Yeah. So I don't know, Rich, if you have any sort of ideas, because I kind of want to unpack this a little bit further, not only for my own sort of knowledge base here, but it is I can't think of a shittier position to be in as a central banker right now.
So, I mean, I think it's a fair enough point, but I think I'm just going to circle back to sort of the way that Keith framed it, which was to say, a lot of this is sort of a distraction. And I think I come at it from sort of a completely different view, but we sort of kind of come to the same conclusion, which is, I think that this is distracting from what I believe is actually, I mean, notwithstanding what's going on in Ukraine. So forgive me for being so callous, but I actually think we're being distracted from what I think is actually sort of a good macro backdrop. And the way I would, the single point that I would look at to sort of as the linchpin, or sort of maybe to confirm my bias, is the 10-year bond yield is still at 195. And I think that if people, and so, yeah, you can look at the markets, and you can look at, all these tech stocks. I mean, I think actually the QQQ is probably flat now, but anyways, you can see the selling off in the futures and all this stuff. But lo and behold, probably the single most important single line item on my screens every day that, kind of encompasses all of the views of interest rate policy and war and inflation and this and that, is at 194.
Hasn't moved, is what you're saying.
It hasn't moved. Sorry. Excuse me. That's right. And I think that, and I think we're, in a way, I think it's what I'm actually going to do for the rest of the afternoon is go out and go drink in the pub. Because I think in these times, you need to sort of force yourself to pull away from the headlines. Because, I was looking at all the macro stuff, and I understand it's, slower moving stuff and slow moving data. But, the New York Federal Reserve comes out with this manufacturing survey starting to improve. Claims, jobless claims came out better than expected, continues to fall. The German, talk about German. Yes, Germany is very, very vulnerable. I get it. We can go into that a little bit later. But the German IFO, which is, I don't know what the acronym is in German, but it's basically a business survey akin to the ISM, but for Germany, it rebounded last month. And more importantly, there is the supply constraints that they were under, which were extreme levels. We're talking about like basically the highest they've ever been, have come off their peaks. I mean, I could go on and on. I'm not going to, but I mean, one last point, which is just you look at the Citigroup Economic Surprise Index, which is also another important indicator to sort of understand people's expectations of economic data versus what actually comes out. That's positive. And so, you have all these, and then again, circle it back to the 10-year bond yield, which is just ticking along at 194, and just saying, actually, you know what, guys, there are definitely some risks, but, global growth seems okay. And so I think it's important for me. I think it's the way that Keith outlined it is really important, to just like focus on what you're good at, what you understand, and what ultimately will determine earnings, margins, and where the S&P 500 is going to go. So that's the way I see it. And back to your question, Steve, is I don't think this is going to change their math at all. I think real interest rates are still at 40-year lows. I think that raising interest rates 25 basis points does not change anything. And I think, frankly, the 2-year bond yield has already done much of the kind of policy work with respect to inflation, interest rate expectations.
Yeah, I mean, I think that's a good point. Obviously, my view is still, I mean, for simplicity's sake here, it's probably very simple, but Bank of Canada is obviously still going to raise rates 25 basis points here in March. 25 basis points is not going to disrupt and royal markets here. But I mean, Keith, I don't know if you have any additional commentary, because I think we're just, you know, the three of us have been going back and forth in our group chat here over the last couple of days, right? And there seems to be a lot of discussion around, you know, is the central banker really your friend anymore, right? I mean, are they truly going to tackle inflation? Particularly, you know, we see markets selling off. Like historically, like there's been a debate really that, you know, central banks, do they really have an inflation target, or do they have an S&P 500 target? And obviously, you know, we see markets selling off here right now. So Keith, I'm curious to see or to hear how you're looking at this.
Yeah, so I want to comment on the Treasury yield, where it is, and also on that. But remember, though, you know, when we first started having these conversations here about, you know, the Bank of Canada, the Fed, and we say, you know, they're not going to raise 7 or 9 times, whatever the Scotiabank number was, because they'll get stopped out for some reason. So it's happening. This is the reason, right? It's coming up. Bank of Canada is up next Wednesday, so less than a week from now. It's their meeting. They're first up, and then
that's going to line up perfectly for the Loonie Hour, which we record on Thursdays. So for a little teaser for you guys next week, we will have full coverage on that. But Keith, continue.
They were originally scheduled to go on the 3rd during our Loonie Hour taping, but they decided to go the day before because they know they knew nobody would watch them if we were recording this. So that's another Twinkie, maybe. But again, like when we make comments to say, you know, the central bank, they'll get stopped out, they're not going to be able to make all these rate hikes. And we said, you know, back then we don't know the exact reason for it, but this is one of the reasons. And again, I'm going to be shocked if they don't raise rates next week. If they do, then I think, you know, you line up to short Canada all day long. If they don't short next week, that's the one.
Sorry, you're saying if they don't hike next week, you short Canada. That's what you're saying.
Correct. Maybe I didn't say it the right way, but that's what I meant to say. Right. So we have that coming here. And again, I think they'll get stopped out at some point. I don't know how many hikes it will be. With, you know, Rich made a good comment about the 10-year Treasury. And, you know, that's a great barometer used during normal market and economic cycles. And, you know, it was selling off up until a week ago because of the whole inflation expectations and all that story with it. And now it got a bid this morning. So the bid this morning is not inflation related. It's simply a flight for safety. That's where it's going. How this affects Canadians is that, you know how we've been talking about credit spreads a bit over the last number of weeks and episodes. Credit spreads continue to rise. So that means mortgage rates are likely to continue to rise. So what that means that there are times when you see like the 10-year Treasury yield come down, sometimes it means mortgage rates will come down with it. But there are other times you have to look at the credit spread on top of it. So with long-term rates coming down in the US as well as Canada this morning on the government bond, credit spreads are likely widening. So this gives, so again, which means mortgage rates can stay high and even go a little bit higher. It really depends on how the banks start pricing risk going forward. So again, it's really important in our world to look at credit spreads, and that's where we're going with it. You know, I mentioned earlier the whole thing about central banks. I think it's just fascinating, guys. Like it really is. I remember a few weeks ago we floated the narrative that, you know, central banks, if they start raising rates and fiscal spending starts to decline, and the economies are not growing as fast as they were before, you know, it's going to create some challenges. And, you know, how can you offset that? And I said before, in the U.S., a strong U.S. dollar, a decline 10, 20% in the stock market and whatever other security people are looking at, that does a real good job of slowing inflation. We also know, I know we joke about the transitory effect with inflation, but the economies have to open up again. If they open up again, then that will help a lot with the supply side. So the inflation story, it can work itself out. And, that's what they're trying to do right now, of course, around the world. But the real question is, like, this whole Ukraine situation, does it really escalate from here? And I think the only way it escalates from here, if somebody really, they get an itchy finger and they make a big policy mistake. And let's not forget the Chinese, because they're involved over in the Pacific. And I do not think the Americans will be distracted with the Russians, that they forget to take the eye off Taiwan, what's happening over there. The American Navy fleet, it'll be like 100 Wayne Gretzky's against, Steve Saretsky on his Steve Saretsky in his bear league. I know Steve is good and all, but
still got it.
Yeah, I know.
Suck,
but those are some. So again, that the central banks now they now have a reason coming up very soon not to hike rates as aggressively is what everyone was looking at before. And then I mentioned before as well that the big market everyone's looking at now to make money possibly is in the euro dollar market and the Canadian bankers acceptance contract market up here in Canada. Again, it's just a fantastic. Again, if you're insensitive about people's feelings around the world, which as a money manager you have to be, like these are the moments you look at for to manage your money.
I mean, yeah, I think that's always a good point. We've talked about it on this show quite a bit, but basically you kind of have to try to you have to keep your emotions out of it, and you have to try to put yourself in like the central banker's shoes and then say, okay, if I'm a central banker dealing with, a massive debt to GDP imbalance, and realistically, in order to fix this, you have to run real negative rates for a prolonged period of time. You're looking for like any excuse whatsoever to not raise rates. And at the same time, though, is you still have to emit a level of confidence to the general public that you are going to maintain the value of that currency, because that's part of like the social contract, right? I mean, like, you're not going to come out and say, hey guys, we can never raise interest rates again because look at the debt to GDP picture, look how bad it is. You have to sort of, it's forward guidance, right? I mean, I think that's like, so much of this is psychological. So again, Rich, I know you're dying to chime in here, but
well, no, I think we also forget sort of the, like, I don't know, for me, I'd like to just take one step sort of under the hood, because I think we spend a lot of time looking at the S&P 500 or whatever, but there are some sectors that are actually doing super well in relative terms that have not done well in a long, long time. And I think it's interesting to point out, like telecoms, that inflation is, as inflation is bad for some people, it's actually really good for others. For the first time in what seems like a generation, obviously I'm exaggerating, the first time in years and years and years, you have telecom service providers, the Comcast, the AT&Ts of the world, all these people, they have pricing power. That sector is starting to outperform. Doesn't trade has a good dividend yield, doesn't have too much leverage. Same with consumer staples. These companies are able to push through pricing increases and keep their margins high. And so we see a lot of the negative headlines on the Facebooks and stuff, but I think it would do us all a little bit of, I think we'd all do a little bit better if we, instead of spending time on those headline indices and stocks, to go dig a little deeper and look at, consumer staples is good. I'm on the energy like train like crazy, of course, but telecom services, basically a sector that's been just unloved for years and years and years and years, is somewhere where actually these companies are making money and pricing power. And I think frankly, that's irrelevant of what's going on in central bank world or whatever. They're not going to raise interest rates enough to affect inflation in the short term. And so that's just something that I think is kind of fascinating.